Hi, everyone. It's AJ with North Capital Mortgage. Hope you all have been very well. And today we are going to talk about one of the biggest headlines in the mortgage industry, which is the 50-year mortgage. There's been a ton of information out there about the possible introduction of a 50-year conventional loan. And a lot of the feedback has been a bit negative. So we want to look at today, what is a 50-year mortgage? What are the benefits? What are the drawbacks? And maybe we can come up with our own opinion about how that 50-year mortgage term would be beneficial for us potentially. So, what is a 50-year mortgage? This is a loan that is amortized over a 50-year period in lieu of the traditional 30-year period. It offers a lower monthly payment because it is amortized for an additional 20 years. So you get an extra 20 years to pay back your principal. And it is easier to qualify for a home purchase or refinance because having a lower monthly payment reduces your debt to income ratio, which helps you qualify for that loan a little bit easier. Okay. So why are they talking about offering a 50-year term? Well, the obvious answer is to combat affordability. Home prices have gone through the roof in comparison to average median income over recent years. But really, if you look back, not just over the recent 5 or 6 years, if you look back over the last decades, the affordability issue has been of concern for a very long period of time. If we look at some statistics, firstly, roughly 75% of US households cannot afford a median priced home today. Secondly, median home prices have risen at almost 60% from 2019 until today. And number three, the average salary versus the median home price. If you look in 1980, 3.2 times your average salary to buy a home, 2010, 4.5 times, and in 2025, almost 6 times your average annual salary to purchase a median priced home. And if you're in California or if you're in New York or some places in Florida, it's going to be a lot higher than that, okay? So let's just take a look at an example of a 30-year term loan versus a 50-year term loan. There's a lot of information on this slide. So the example here is a 500K loan, okay? And let's look at the 30-year term first. 6.25% on a 30-year fixed. Principal and interest payment is $3,078. Now your total interest over 30 years, if you stay in that loan for 30 years, is $608,000. So that means your total repayment is $1.1 million. You are paying more in interest than you are in principal on a 30-year term, okay? And that is today's standard. On a 50-year term, and I have the rate a little bit higher because generally when you offer a longer term, the interest rate is going to be a little bit higher. So at 6.35%, principal and interest is lower, $2,771. So you're lowering your monthly cash flow or increasing your monthly cash flow by about $300 a month. Your total interest on this loan over 50 years is $1.162 million, and your total repayment is $1.6 million. That's more than 3 times the principal balance. And I have these little charts here. If you can look at this here on the 30-year example, you're going to pay roughly 50% of that principal right at the 20-year mark. You can see your 500K principal coming down, and it meets 250,000 right at about 20 years. On the 50-year term, you don't meet roughly 50% pay down until about the 40-year mark. So that is quite a difference, okay? So obvious reasons here why there's a lot of pushback against offering a 50-year term. Are there any advantages to a 50-year loan? Well, as we mentioned, it gives a lower monthly payment, easier to qualify for a loan, and my favorite is choice, okay? We as consumers should have the ability to choose what type of loans we think are best for us, but the key factor here is education, okay? A lot of people are going into loans, they don't really understand the interest over time, but if we can educate ourselves and it makes sense to us, then perhaps we should have that choice. Let's look at a choice example is what I call it. So a 500K loan amount, let's say you're an investor and you have a target to sell this property in 5 years. So There are 5-year ARMs available for this type of strategy. But let's look at the 50-year term at 6.375%. And you have a principal and interest payment of 2771 on a 5-year ARM at 5.625. You have a 5-year fixed term over a 30-year amortization, and your payment's going to be about 2838. Okay, so a little bit higher monthly payment. But what does that do for you? We can't predict the future, right? So if we have a target to sell in 5 years, but let's say in 5 years rates have gone up dramatically, okay, and that pushes the price of homes down. So maybe your profit isn't quite there and you need to hold a little bit longer. Well, if you have to hold for a couple more years and you're on a 5-year ARM, that interest rate can go up as much as 3, sometimes 4%. If we use 3% increase as an example, now your monthly payment is at $38.44. So in hindsight, if you chose the 5-year ARM for your strategy, but you had to have held that for an additional couple years because of market environment, it would have been better off had you gone for the 50-year term. So just one example, just some food for thought, if you will. So is this a good way to combat affordability? Is a 50-year term a good way to combat home prices today? In my opinion, it is not the best strategy to use the buy side, if you will, to tackle affordability. What that means is I don't think we should create strategies to put the burden on the buyer to tackle affordability. And that's essentially what the 50-year term does. We should probably be looking at the sell side, thinking of ways to make home building more affordable, maybe decrease regulation, or perhaps look at bettering the overall economy to help affordability. Okay, so there you have it, the 50-year term. If you have questions, if you want to have any discussion, I'm available. AJ at North Capital Mortgage. I appreciate your time. Talk to you soon.